the expectation for new copper supply is only likely to be about 2% over the next couple of years. So of the forecasted mine supply of copper in the next several years from projects that are coming on stream is only going to equate to 2% of that supply. Contrast that with coming out of the great financial crisis in 2012, 2013, that new supply was equal to 12% of total supply. So you can see that there is no solution here because you can't create a copper mine out of thin air and expect it to go on stream and start producing next month. These things take years and years. So the fact that you have demand, which is going to continue to grow aggressively in order to meet all the new carbon targets that every country, every major economy just committed to over the last couple of months, right? Lowering carbon footprints dramatically by 2030. That's going to drive the demand. At the same time, you have ESG pressures on banks to limit financing for said projects. What is going to be the outcome? The outcome is going to be clear. It's going to clear that supply-demand imbalance is going to be priced. Look, I think the real opportunity here is in the laggard markets of the reopening. So the markets that have not participated in that first move to value to non-US markets. And Latin America and Brazil sits right there. And you know, I've talked about being bullish about the real over the last month or two. The real has strengthened and looks like it's going to continue to strengthen. And at the same time, the equity space has absorbed all the bad news, whether it's about the potential for Lula to come back and compete in the presidential elections, whether it's cabinet resignations, whether it's COVID. Again, you have to let the market tell you. And the market is telling you, in the case of Brazil, that it has absorbed all that news, all in the price. And so going forward, the opportunity is for Brazil to kind of recapture the traditional relationship with rising commodity prices. If you look at any kind of historical chart and you chart commodity prices in Brazil, you see in Brazilian equities, you see they have a very close relationship. And our friend John Van der Wal, who does some great, puts out some great charts, just showed a chart, I think today on LinkedIn, showing exactly this, that commodities have skyrocketed and Brazilian equities have done nothing. And so I do expect that relationship to kind of come back toward its normal condition. To me, I think it's interesting to contemplate the following. You have, on the one hand, what we spent the first 10 or 15 minutes talking about, physical price pressures in the commodity space, right? You have, on the other hand, the digitalization of everything. So to me, what's really interesting is how do these two forces, who's going to win? Who's going to be the boss of the fight between digitalization of everything and physical commodity price pressure? I think it's going to be the digitalization of everything because it's so much broad, right? We're not going back to the 70s, like when oil prices shot up and inflation ensued. That's not at all what we're going into because we have digitalization of everything, you know, firing ahead at COVID speed, spreading across the entire global economy. And so to me, I'm a believer, continue to believe, as we've talked about for months and months, transitory inflation. We're going to see it on Wednesday, right? Wednesday CPI, the forecast number is 3.6%. It will be the highest headline inflation number in years. I think the testing time for fixed income is going to come much more later in the summer because I think the issue is not all these crazy numbers that we're seeing, you know, all around the world in terms of economic statistics. I think that the testing ground is going to be when data normalizes and investors can see whether or not all this spending has propelled us onto a new growth path, a higher growth path, more equitable, sustainable, good for the climate growth path, or do we go back to kind of the subpar growth that we saw in the decade between 2010 and 2020, which was like 2% developed economy growth. And so to me, that's really going to be the testing ground when you have clean inflation numbers, which will be like, let's call it the June or July inflation prints in the US. That's right around when you're going to have Jackson Hole and the Fed talking in August. That's when you have thin markets, people on vacation. That's when you have poor seasonality. So to me, that's really probably where we're going to get the testing ground. I think that the tech stuff doesn't act well. I think it does reflect a view that the economy is going to continue to strengthen, that you are going to have higher rates gradually, and people just basically more even than higher rates. I think people are just reallocating. You know, there's been so much money put into growth stocks in the U.S. over the last 10 years. It's been a 10-year run. And this is what I'm saying about value in the early innings, commodities just at the very beginning. Because these relationships got so extended that you're going to have these periods where you're going to see data activity be ugly because it's all sellers and no buyers. And now that most of these vehicles have broken their 200-day moving average, technically they're weak. There's not a lot of support underneath them. And because they are kind of thematic and therefore don't have a lot of opportunity to kind of tether or hold to any one particular kind of data point, right? It makes it hard to say, okay, I'm going to put a foot down or stick a fork here and I'm going to buy here. And so to me, those particular things continue to look unappealing. The tech names, the FANG names, fantastic earnings, and they've done nothing but go down ever since. So I think we're in a process. We're in a reopening unlike anything that we've seen, and therefore we have to kind of respect that process is going to give you some head fakes. And in the intervening period, you want to make sure your portfolio is structured in a way that allows you to participate. You're not too far into one side or the other, which is, you know, certainly with the thematic space is definitely a challenge. Is, you know, how do you size and position within a global multi-asset portfolio? And so, you know, you do have equities, you do have bonds, you do have commodities, you do have thematics. And so across that space, the objective obviously is to have a point of view as to where you're going and then have a portfolio that reflects that view and is not too top heavy on either side, and therefore can ride through some volatility. Again, as we talked about, pothole markets, right? Today was a perfect example of a pothole. Right, you're driving down the road this morning, things were great. Driving down the road, everything's fine. And boom, around 1 o'clock this afternoon, 1:30, 2 o'clock, the market hit a pothole and everything just sold off aggressively. So, you know, we'll see. Those are days when you hopefully can be a buyer and not a seller. If that's the case, then you can look to participate in certain things. But from our point of view, a global multi-asset portfolio with a good exposure to commodities, to thematics, to equities, and limited exposure to fixed income is how we want to be positioned. We also expanded our position in Latin American equity considerably. So it's now one of the leader positions in the equity space that we have. Very bullish. As I said, I like the risk reward. I see very limited downside risk. I see considerable upside opportunity for those equities to kind of come back towards the commodity relationship that they've had historically. So in essence, we slightly reduced our U.S. equity holding. We went more overweight with that Latin American ad, more overweight the non-U.S. equity markets. We took down the thematic a little bit, but basically rearranged within it, away from kind of the broad brush, open-ended growth and more towards commodity mining specific thematic plays. As actually reminded me when we talked about European earnings, I would also mention that you're starting to already see, you know, very significant earnings revisions up in the U.S. and in Europe in particular. And for 2022, starting to see estimates for the S&P of $225, $215, $250 is the highest number I've seen to date. But just to take that 250 number and agree, and again, it's on the high end, but $250 earnings in 2022, and you divide the S&P at 4,200, call it today, that puts the S&P on next year's earnings at less than 17 times earnings.
Yeah.
So again, it kind of argues against this mindset in the headlines about bubble this and bubble that. A market that is at 17 times next year's earnings is not in a bubble.